Okay, today we are going to be talking about REITs, real estate investment trust. What is it? Does it make sense to invest in it? What's the tax advantage of investing in it? What's the pros and cons when investing in a REIT? And is it better or worse than investing in just a regular rental property that you own yourself or with partners? Okay, so what is a REIT? Think of a REIT as, for example, when you buy stocks, right? When you buy stocks, you buy shares in a company. So REITs are similar. You're buying shares, but instead of a company, you're buying shares in a property. This could be a commercial building, a apartment building, a office building, hotels, warehouses, data centers, malls, shopping centers, etc., etc. Okay, so think of it this way. Okay, there's a company who buys, let's say, these buildings, and then they finance these buildings, and then you are able to buy shares in these buildings. And you, as an investor, you get dividend income, which is taxed, and also your tax on our share price appreciation when that's sold also. But what's interesting about REITs is that they are obligated to pay out at least 90% of the taxable income to their investors as dividends every year. So there's a couple things here. So as a company that operates the REITs, there's a lot of tax advantages for them to do this, but there's also a lot of restrictions also. So some of those companies, one that comes to mind is Sunrise, right? Sunrise is one of the better known REITs out there. Okay, so how does a REIT work and how is it a tax advantage for the companies like Sunrise to operate a REIT? So the first thing is that REITs are normally C corporations. Okay, so what's the difference between a C corporation and an S corporation and an LLC? Well, C corporations are taxed individually, and S corps and LLCs flow through to the owner's tax returns, and then they get taxed there through a K1. C corps don't do that. C corps pay their own tax. Okay? So remember, C corps pay taxes on their own profits, more specifically, and then shareholders pay taxes again when dividends are distributed. So this is a good thing for the REIT company. So when the REIT does a distribution, they deduct that, and then all the income is taxed once, which is through the investor level. Okay, this is what you call single level taxation. So that means that the corporation distributes 90% of their dividends, and then when the dividends hits the investors' accounts, then they are taxed on the investor level. The corporation, a C corp, is not taxed on that dividend. Okay, and then once those dividends are distributed, they are normally ordinary REIT dividends, which is the most common, and this is taxed as ordinary income, not qualified dividends. Okay, but what's good about this is that as an investor, you get a QBI deduction about it for this. So QBI deduction falls under section 199A, and you get a 20% deduction. So let's say you get $10,000 of dividends. So 2,000 of it will be a QBI deduction. So as an investor, you would only get taxed on $8,000 of the dividends. So then therefore the effective tax rate is actually lower than the normal ordinary income. Okay. So another thing to be mindful about is if the REIT sells a property and distributes the gain, there's going to be an additional long-term capital gains tax for the investor. So not only are you getting taxed on the dividends as an investor, but you're also going to be taxed on the long-term capital gains when the property sells. Okay, and then there's appreciation on your shares. Okay. So one thing that kind of sucks about REITs is that you don't get the benefit as an investor. And one of the biggest advantages or benefits in investing in real estate, which is depreciation. This is because REITs claim depreciation internally, meaning that when you invest in a REIT, you're not going to get a K1 showing your share of the depreciation. So what happens is that sometimes since the REIT claims the depreciation internally, sometimes they distribute more cash than taxable income. So this amount is not taxed immediately. It reduces your basis in the REIT shares, and tax is paid on this amount later when the shares are sold. Okay. So again, as an investor, you don't get depreciation when you invest in a REIT. You don't get a K1. Okay. This is not attractive for a lot of investors because when you own a property or you have partners that you own property together with, you get a K1. In that K1, it has your share of the depreciation. And if there's bonus depreciation, you get your share of the bonus depreciation, which sometimes can generate a paper loss, which can offset your other forms of income. I'm specifically talking about it can offset your active income sometimes as well. So that's one of the biggest advantages of investing in real estate. But when you invest in a REIT, you don't get to take advantage of those depreciation benefits. Yes. So again, one of the biggest advantages of investing in a REIT is you get dividends, and then when you sell your shares, then there's appreciation there. But you don't get depreciation. You don't get a lot of the tax deductions on the property level when you own your property yourself or with partners. And you don't get to leverage your investment. Meaning, for example, right, when you invest in a property, for every dollar, you get $4 of our property value. That's because a lender normally provides 75% of the property value through a mortgage. And that you can't do that in a REIT, right? You can't invest $1 and then get $4 of REIT shares. That's not how REITs work. So you're not getting debt leverage, you're not getting depreciation. So there's a lot of things that you're not getting when it comes to REITs. Okay. But like with everything else in life, there's always pros and cons. So some of the pros in investing in REIT is that passive and simple, right? You just sit back, you just collect dividends every quarter or every year, depending on how often the REIT pays dividends. There's no property management companies that's driving you crazy. There's no tenants calling you at 2 o'clock in the morning telling you to fix a toilet. There's no repairs and there's no financing, right? You don't have to worry about do you qualify for a loan to buy a REIT, right? Liquidity. So one of the disadvantages in investing in real estate is that illiquid, right? So meaning that if you put money into real estate, you better make sure that you don't need that money in the next 5 years to buy food because that money is going to be stuck in that property. Versus if you buy REITs, it's kind of like shares of stocks, meaning that you can buy and sell stocks anytime you want if you need cash, right? So diversification, when you invest in a REIT, you can own shares in hundreds of different properties, not just one property, right? So kind of like the old saying, don't put all your eggs in one basket. So when you invest in a REIT, you're buying shares in different properties. So if one property doesn't do good, the theory is that other properties will do fine, which will hedge your investment. Yeah, so also it's lower capital requirement. Also, you can invest a couple $100, buy a couple shares of REITs instead of needing, 25, 50, $100,000 to invest in a real estate property on your own. Okay? Reliable income, right? So REITs tend to pay more consistently with the dividends versus if you're in syndications in the last couple years and you're investing in C-class properties, you probably did not get distributions in a while. So that's something to consider as well. Okay. So according to documents online, it says that REITs normally have a dividend yield of 48%. I would double check that. I've never invested in a REIT before, but I would double check that if they really do pay out 48% in dividends. Okay. Yeah, so cons of investing in REITs, I've already mentioned a lot of this is that no direct tax deductions, you don't get depreciation, cost segregation, bonus depreciation, that's all out the window. And also, dividends are taxed at ordinary income, which is higher than other forms of income like capital gains, okay, or passive rental income, right? So remember, if you invest in real estate directly, you could, even though you're cash flowing on your properties, you could still get a paper loss through depreciation, which could result in you paying $0 in taxes, which is not possible when it comes to REITs. And then another thing about REITs is that you have no control and management or strategy. You are just a passive investor. You have no say on how the operator is going to manage the property, what's their strategy on when they're going to sell the property. You have no say on that. You are just a shareholder. Okay? And also, REIT prices can fluctuate up and down, kind of like Stocks versus real estate prices are a gradual rise or a gradual decline, depending on what market cycle you are in. Okay. So the pros of owning property yourself is you get a lot of the tax benefits that REITs do not, right? You get leverage. You could use a mortgage so that for every $1, you could invest into $4 of properties. So meaning that if you have $250,000, you could buy a $1 million property, and then over time, your tenants can pay down that $750,000 mortgage, which builds you equity and net worth. That is not possible when it comes to REITs. Right? Appreciation, kind of, right? Because yeah, you don't get that appreciation on the property, but you get that appreciation of the shares, which when you sell the shares, you get taxed on the appreciation. Also, you forego a lot of the tax strategies that are associated with real estate when you invest in a REIT. For example, you don't get to do anything that you want, right? Cons. So cons is you need to be more hands-on when you are investing in real estate that you own directly. You need to coordinate with the property manager, or you need to self-manage the property yourself. Versus a REIT, you're kind of more hand-off, right? And then also illiquidity. So your money is stuck in the property for 5 to 10 years. So hopefully you do not invest all your money into real estate because you will not be able to get that cash out if you need to buy food or go on a vacation or take your wife out on a date, right? All the money is stuck in real estate if you buy the properties yourself directly, right? So also, you will need more cash when you're investing in actual real estate that you own directly. Yes, there's seller financing. I already know that there's somebody in the comments right now who is a smart mouth who's going to say, what about seller financing? 0% seller financing. Yes, that's true, but those are harder deals to find. Okay. And then again, risk concentration. You're putting more of your money into one property instead of diversifying your portfolio. Right? So yeah, and then I've already mentioned the pros and cons of a REIT. So passive, just diversified. You could sell the stocks anytime that you want if you need cash. Okay. Cons is no tax, fewer tax advantages. Your tax for the ordinary income, for the dividend, and you have less control. So which one makes more sense? Should you invest in a REIT or should you invest in properties directly? And the answer is it all depends, right? So what's your situation? Are you looking to be more hands off? Then okay, then maybe a REIT makes more sense for you if you just want to collect dividends every quarter and not worry about the real estate part, and you want to be more diversified. Okay, if you want to have more control over your investments, if you want to leverage your every dollar that you invest in real estate to build equity and net worth over time, then maybe investing in real estate directly makes more sense for you. So if you want some more tips about your personal situation, should you invest in REITs? Should you buy a property yourself? What's the tax advantages? What's the tax consequences of either one? Please feel free to reach out to our team. Schedule a call, hit the link below, and don't worry, your accountant handles that.